Zero down mortgages are starting to make a comeback as housing costs and rising mortgage rates are making it very difficult for people to be able to go out and buy a home. So the solution the banks have come up with is zero down mortgages for some people. I already made a video covering Bank of America's new zero down program for minorities, where essentially Bank of America says that they want to help empower minorities own a piece of the American dream by helping them in some neighborhoods be able to buy a home with zero money down, meaning the bank will cover your closing costs, they'll cover the housing costs, and they'll even cover your PMI. And Bank of America is saying that they're doing this out of the good of their heart to help minorities go out and build equity in these homes. Now, when in reality, this program has a lot of consequences if you don't understand how it works. But today, I want to dig a little bit deeper on this, because if you have the opportunity to buy a home for zero down, is this good? Should you take it? And how can you actually use it the right way? Because the reality is that for 80% of people who are going to take advantage of a zero down mortgage like this, it is going to end up being very bad. But for something like 20% of people, maybe 15, maybe 25%, depending on who the people are, it will work out very well. Now, if you do go out and get a 0% mortgage, I would recommend you be in this category, not this category. And this is where you have to understand how to use the system to your advantage, because now let's talk about this. Banks are in the business of making money. How do they make money? By lending money. The more money that a bank can lend out, the more money that they can make. So it's in a bank's best interest to lend as much money as possible. If a bank can lend you $500,000, they'll be more than happy to do that. If a bank can lend you $1 million, they'll be more than happy to do that. If a bank can lend you more money, they will want to lend you more money, because that's how they get paid. They want to lend out more money because then they will get more interest on more dollars. For you now as a person, you want to minimize and have little to no consumer loans, aka loans on your liabilities, things that are not paying you. And this is where you might say, but Jaspreet, my home is an investment. So shouldn't I go out and borrow as much money as I can on it, because now I'm borrowing money to build wealth into this investment that's gonna make me wealthy? Well, let's talk about that, because no wealthy person ever talks about how they built their wealth by buying a big home and then paying it off. That is not how any actually wealthy person became wealthy. They become wealthy by owning real assets. This might be real estate as an investment that you're buying to rent out to other people. This might be stocks. This might be your own business. There might be a business that you buy. Real wealth is built through this type of equity. Because now when you invest in a real estate rental property, you're building equity in that. When you're investing in stocks, you're building equity in the stock market. When you're investing in a business, you're building equity in the business. Now, you might get confused because you're building equity in all three of these things, and when you're paying off your home, you're also building equity. But the equity in your home is the worst kind of equity as compared to all of these kinds of equity, because these kinds of equity, the stocks, the businesses, the real estate investments, will pay you for owning them. And they'll pay you while you own them. While you're home, you hope that it'll pay you, because you hope that you'll be able to sell it for a profit when it comes time for you to actually sell your home. Until then, it's the money pit. Until then, you're paying money in your mortgages and your taxes and your insurance and your maintenance and your upgrades and everything else you got to do with your home until you go and sell it. And then when you go to sell it, you got to hope that the area that you bought it in continue to grow, and you got to hope that property prices have increased, that we can actually sell your home for a profit. If you can't sell it for a profit, well, now for the last 30 years, you've been trying to pay off your home, and now you don't even make a profit. Now, to be fair, this Bank of America zero down mortgage program is not the only way that you can get zero money down on a home. You can go out and get a VA loan if you qualify. You can get a USDA loan if you qualify. The reason why this Bank of America zero down mortgage program has been getting a lot of attention is because it's offering this zero money down mortgage to regular people who don't qualify for a USDA or a VA loan. And by regular people, I mean regular people who qualify in certain neighborhoods, in certain cities across the country. And why are they targeting people of the lower economic class? They say it's to help them build wealth, but in reality, many of these people also don't have any idea of how to manage their money. They don't understand how to build wealth, and they don't understand how equity works. And what will happen to the vast majority of them is now you get stuck into a mortgage that you can't afford because you bought a home that's bigger than you would like, because now you think you're building wealth, and now you're spending all of your time trying to pay back the bank. Well, some people will understand how to do it. You have some people, and this goes across income levels, this goes across ethnicities, this goes across all people. In every type of income level and every type of socioeconomic group, you have this 80-20, where 80% of people are probably going to get hurt, 20% of people will benefit when you have financial programs like this. It doesn't matter if you're talking about 20,000 salaries or 200,000 or $2 million salaries. There's always going to be programs like this. Well, in this case, you're going to have some people, 15 to 25% of people, that will use this program and live small, maybe buy a home that is way within their means, that's smaller than probably all their friends are buying, because now they want to buy something they can comfortably take care of, that they can comfortably use to pay off their mortgage, that they can comfortably live in without stressing about the payments. And now, what are they doing? They're building equity in these homes while they're investing their money in other places. They're living small, but now they're working to build wealth, and they're also working to pay off their home because that's something that they wanted. And now instead of using this down payment to buy a home, they can use this down payment to go invest in something else. And this is where the majority of people are not going to do that, but some people will, and this program will very benefit them. And this is where, again, it's understanding the financial education. That way you can be on this side, the 15 to 25%, where you understand how to take advantage of things that come your way, instead of being the person that gets screwed over, because these are the people that are really going to benefit the bank, because now you're borrowing way more money than you can afford. You're going way bigger. You're stretching yourself thinner because you're saying, hey, I can go out and buy a big home. I don't got to worry about the PMI. I don't got to worry about the closing costs. I'll worry about the mortgage payments later. And now you're stuck into a much bigger home, which means bigger property taxes, bigger insurance, bigger utility bills, bigger maintenance costs, bigger upgrade costs. All these things now become a money suck for you as you try to just make the payments. Now, of course, this is where you want to be staying up to date on what's happening, because this program probably isn't going to be the last, and we're going to be probably seeing more things like this, because now as the housing market changes, as it becomes more expensive for people to buy homes because mortgage rates are going up, banks are going to want to get more clever to get more people to borrow money and to get more people to borrow more dollars. And of course, we'll be keeping you up to date on Market Briefs, which is my free financial newsletter, which is why if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. And you can read Market Briefs in less than 5 minutes every morning. And I promise you're going to love reading Market Briefs. And if you don't, well, then you can just unsubscribe. But you're not going to want to, because it's free and because it's so much fun and very educational at the same time. There's a big misconception that when you rent your home, you're just throwing your money in the garbage, versus when you buy your home, now you're investing your money. But that's not really how it always works. Because now when you go out and buy a home, you're not just paying all this money to build equity in your home. Like if you look at an amortization schedule, what you'll see is if you get a 30-year mortgage, for the first half, almost 15 years of your mortgage, it's about 14 years and some change, but for the first almost 15 years of your mortgage, the majority of every payment you make is going directly into the banker's pockets in interest. Why? Because mortgages are front-loaded. Banks want to make their money first. So what do? Well, when you make your $2,000 a month payment, almost every dollar in the $2,000 a month payment in the beginning is going directly in interest, and a teeny tiny little bit is going to actually pay off the principal balance for your mortgage. So when you pay this $2,000 a month, very little is actually paying off this debt that's actually building you equity, that's actually paying off your principal in the mortgage, while the vast majority in the beginning is going directly into the banker's pocket. It isn't until year 15, into year 16, into the second half of your mortgage, where now most, meaning more than 50% of your payment is going into your principal. So after year 15, now out of this $2,000 that you're paying a month, now $1,000 is going into your principal to actually build you equity. So it's not like you're just getting this free ride to build this equity in your home. You got to pay the bank in order to do that. And now when we talk about paying rent as just throwing money away, you're getting a value. I mean, you're getting a home. Like when you go out to eat at a restaurant, you're not saying that you're paying the restaurant owner's mortgage. When you go out to drive in an Uber, you're not saying that you're paying off the Uber's car payment. When you go out and do anything, you're not saying that you're paying for this person's mortgage, when in reality you are. Anytime you spend $1 anywhere, whether it's at Chipotle, whether it's at Apple, whether it's at Lululemon, whether it's at Amazon, you're paying somebody something in order to get this value. Anytime you pay somebody something, this is how they make money. When they make money, some of that money that they earned is used to pay off their mortgage, used to pay off their car, it's used to pay for their life. And so anytime you spend money, you're paying for somebody's mortgage. In this case, the rent is just a direct payment to help somebody pay for the mortgage on the home, but the landlord also bears all the risk because if something happens to the home, or property taxes go up, or insurance goes up, or they have to make a repair or an upgrade, or the city comes in and they have to now mandate new repairs, new upgrades, the landlord's the one that has to bear all that cost, not you as a tenant. Sure, you might have to deal with higher rents, you might have to deal with the annoying landlord, but you can always leave. You don't have that same commitment like the landlord does, where now the landlord is stuck. When you own a home, you have to take care of the home. Now, there's nothing wrong with owning a home. I mean, it's nice to own a home. It's nice to be able to own a home free and clear. Now, you don't got to worry about a housing payment. But you don't want to be stretching yourself too thin to buy a home just because you think it's going to make you wealthy. Buy a home when you can afford it, when you don't got to worry about the payment. That way now you can actually afford the payments that you're making, and then buy a home and not worry about the price. We've already seen the consequences of very loose lending practices when it comes to real estate, because when you have that happen, people will want to take advantage of these programs and buy a home because most people are not financially educated. It's not in the bank's best interest to keep you financially educated, because if you were financially educated, you wouldn't want to take this mortgage. You're going to learn about the actual cost of this, and you're going to want to live smaller, borrow less money, and have a bigger down payment. That's not in the best interest of banks. And so yes, the banks are greedy. They want to make money. Every corporation wants to make money. If your corporation was not making money, you would not have a job. That's the way that the system works. So banks are in the business of making money. Now, your job is to be financially uneducated. This is where things really suck, because most of us are never financially educated. Most of us are never taught about money. But you have to get financially educated, that we know how to use the bank to your advantage, that we know how to buy things from corporations that you can afford, that we know how to spend your money the right way, because what happens to so many people when you don't have this financial education is how you make money and you just give it to everybody else around you, making everybody else rich, making your banker rich, but it keeps you broke. This is where now you want to get financially educated. That way you can use the system for good and use your money to make yourself wealthy before you make everybody else wealthy. But at the very core of that, it's not stretching yourself too thin to buy something just because everybody else can, just because the bank says you can afford it. You need to define what you can afford, not let the bank define what you can afford.
The banking system is there to get you to borrow money. Fact. Now that we understand that, how then can you potentially use it to your advantage? So how do you now become wealthy? Well, first is understanding how the system works, and then believing that you can do it. Because there's two aspects of believing.